Welcome back to the deep dive. Today, we're plunging into, well, a really interesting moment in the digital asset market. On one hand, things seem kind of stable. Bitcoin's holding firm near, what, $103,000.
That's right, around that mark. But you're right, the surface stability is a bit deceptive. Beneath that $100 K level, the whole ecosystem is undergoing this foundational renovation.
Foundational renovation. I like that.
Yeah, because our sources today, they show this isn't just consolidation, it's really professionalization. We're seeing assets specializing, real political integration happening, and these huge infrastructure pivots. We're talking multi-billion-dollar pivots.
And that's pushing crypto hardware kind of unexpectedly right into the heart of the global tech economy.
Exactly. So our mission today is to distill all these complex shifts, boil them down into the crucial takeaways you need to grasp.
And the story we're finding, it's full of surprises, isn't it? Like what seems like maybe bad news, ARK reducing their Bitcoin price target might actually be, well, bullish.
Precisely. Yeah. Bullish in a mature market sense, and we definitely have to talk about the miners. Bitcoin miners struggling, yet signing these massive deals with giants like Microsoft and Amazon. It's quite the turnaround story.
Okay, so let's unpack all of that. We'll get into ARK's revised BTC target, look at the Glassnode data, who's actually buying and selling right now. Then there's the $2 trillion tokenization forecast from Standard Chartered.
Huge number.
Yeah, and key political moves that are sort of normalizing digital assets at the very highest levels.
Lot to cover.
Let's start with that headline grabber. Cathie Wood and ARK Invest. They lowered their high-end 2030 Bitcoin projection, dropped it from $1.5 million to $1.2 million. I mean, $300,000 off the top, that sounds like they're backing off, doesn't it? Is it a loss of confidence?
It does sound like that initially, I agree. But when you dig into the reasoning, it flips the script. Wood was quite specific. This isn't about losing confidence in the overall digital economy.
Okay.
She actually framed it as the opposite, as evidence of success, of specialization within the market.
But hold on, how is that not just spin? If they thought Bitcoin would hit $1.5 million based on certain uses, and now they're cutting that because something else is doing one of those jobs, doesn't that mean Bitcoin lost some potential? How do we know it's not a failure in that area?
That's a fair question.
Yeah.
But the key is which function is being, as she put it, usurped. Wood told CNBC that stablecoins are taking over the role ARK initially saw for Bitcoin in, like everyday transactional payments.
Ah, okay. So not the store of value role.
Exactly. That role, Bitcoin as digital gold, the long-term value reserve, the hedge against instability, that's actually strengthening. It's becoming more specialized in that core function.
So the ecosystem is growing up, dividing the labor. Bitcoin's the digital gold. Stablecoins are the digital cash for daily stuff.
You got it. And that specialization actually makes the whole digital economy stronger, more resilient. Stablecoins, usually dollar-pegged, they're just better suited for quick payments, remittances, especially in places with high inflation. Think Venezuela, Argentina, places where trust in local currency is, well, shot.
That distinction really clicks with the institutional interest in stablecoins then. We've got Standard Chartered Bank, a major player, estimating over $1 trillion might flow from traditional banks into stablecoins by 2028.
$1 trillion.
Yeah.
And that money isn't chasing Bitcoin's volatility, it's seeking stability in efficient payment rails.
Yeah.
It validates that specialized role perfectly.
So stablecoins are becoming this essential plumbing for the digital economy.
Absolutely.
Yeah.
Viewed as critical infrastructure now. The market's getting smarter, basically, assigning the right jobs to the right tools.
So even with ARK's reduced forecast, the baseline is still pretty high, right? $600 K base case, $500 K conservative for 2030.
Exactly. Still incredibly bullish numbers. It's just a specialized bull case now, not a collapsed one. It's about maturity.
Specialization, not stagnation. Got it. Okay, let's shift gears. Let's look at the market right now, around this $103,000 level. Glassnode data you mentioned shows a real split in who's buying and selling. So if the price isn't really taking off, who's putting on the brakes? Who's selling?
Well, the data is pretty clear on this. The selling pressure, the distribution, it's coming almost entirely from the very top. We're talking wallets holding over 10,000 Bitcoins. The whales.
The whales are selling.
They've been consistently selling pretty strongly, actually, for about 3 months now, since August.
Okay, so the biggest players are taking some chips off the table, but what about everyone else? Are the smaller fish, the mid-sized investors getting spooked by this? Are they backing away?
No. Quite the opposite, interestingly. Wallets holding less than 1,000 Bitcoin. They are firmly, decisively in accumulation mode. buying the dip, basically.
So a clear divide.
A very clear divide. And this is really different from earlier this year. Remember the tariff tantrum back in April?
Oh, yeah, that 30% drop to 76K.
Right. Back then, we saw everyone selling. Deep distribution across all wallet sizes. Now, it's concentrated selling at the very top, and the smaller, maybe more long-term focused holders seem to be seeing this as an opportunity. They're absorbing that supply.
That's the interpretation, yeah.
Yeah.
Okay, so accumulation patterns are interesting, but let's talk infrastructure. The miners. You mentioned they're in survival mode. Hash price is terrible. Shouldn't we be seeing, like, mass bankruptcies? What are they doing?
The stress is definitely real. I mean,
Right.
cash price, that's the daily revenue per unit of computing power. It slipped to around $42 per petahash per second.
Wow, down from over $60 in July.
Exactly. Down significantly.
Yeah.
And that $42 range, that's really tough, especially post-halving. For the smaller guys, the less efficient operations, it means they might not even be covering their electricity costs. It forces shutdowns.
So the basic Bitcoin infrastructure is under serious pressure, but they're not just folding. You mentioned a pivot. That sounds like the real story here.
It is the story. It's a massive technological pivot. Instead of just shutting down or consolidating in a shrinking mining market, tech companies are taking their expensive computing infrastructure, their energy setups, and they're converting it, dedicating that capacity away from just Bitcoin mining and towards general computation, specifically for artificial intelligence workloads. AI.
Wait, really? They can just repurpose Bitcoin mining rigs for AI?
Not directly the specialized ASIC miners, but the overall infrastructure, the power contracts, the cooling, the facilities, and increasingly miners were already diversifying into GPU capacity, which is prime for AI. They're repurposing these huge investments.
And this isn't just a small side hustle.
Oh no, we're talking billions here. Look at Cypher Mining. They just signed a 15-year, $5.5 billion contract. Who with? Amazon Web Services, providing computing power.
$5.5 billion, wow.
And then almost right after, IRN announced a deal, $9.7 billion, providing GPU services for, wait for it, Microsoft.
Okay, those are staggering numbers, Microsoft and Amazon. So these aren't just temporary fixes. This is a strategic shift.
Absolutely. It's a core business transition. They're seeking stable, massive revenue streams to offset the volatility of Bitcoin mining. And think about the implication. The physical hardware built for crypto is now directly powering the global AI boom. It plugs crypto infrastructure into the mainstream tech world.
That's profound. Moving from this niche, volatile mining game to providing essential, stable utility for AI giants. Okay, that leads us perfectly into the institutional side, because Standard Chartered is talking about an explosion in tokenization.
Yeah, it connects perfectly. If you zoom out, the institutional hunger for tokenized assets is just immense. Standard Chartered's forecast is mind-blowing. They predict real-world asset tokenization RWA will hit $2 trillion by 2028.
$2 trillion. That's up from, what, $35 billion today?
Exactly. A 57-fold growth in just 4 years. It's astronomical.
Why are they so bullish? I mean, what's the big problem tokenization solves that makes them predict that kind of explosive growth?
It really boils down to efficiency and accessibility. Think about traditional finance. Slow, siloed, works 9 to 5 weekdays, basically. Decentralized finance using tokens offers this trustless framework. It means 24/7 trading, instant settlement, the ability to own fractions of assets, things that are clunky or impossible in the old system.
Okay, efficiency. And where do they see that $2 trillion going? What kind of assets?
The bulk of it, according to their prediction, goes into the liquid stuff first. So $750 billion into tokenized money market funds, another $750 billion into tokenized U.S. stocks.
Makes sense.
Then the remaining $500 billion is split, about $250 billion each for tokenized U.S. funds, like ETFs, and then the less liquid stuff, private equity, real estate, corporate debt, getting tokenized.
And this massive $2 trillion market, it relies heavily on that specialization we talked about earlier, right? The stablecoins.
Absolutely crucial. The head of digital asset research at Standard Chartered explicitly said, stablecoin liquidity is the prerequisite. It's the necessary plumbing. Stablecoins are the on-ramps and off-ramps, providing the speed and certainty needed to handle that volume of tokenized value flying around.
Wow. Okay. Infrastructure shifting, institutions piling in. Let's look at the political arena now, because we're seeing some pretty strong signals there, too. President Trump made some big statements this week.
He did. He came out very strongly, declaring the U.S. is ready to be the Bitcoin superpower and the crypto capital. And interestingly, he framed digital assets as something that could alleviate pressure on the dollar.
That phrasing is key, isn't it? Alleviate pressure. Because for years, the narrative from many politicians was that crypto was a threat to the dollar, a rival.
Exactly. Remember 2022? The dollar index soared, and Bitcoin crashed from, what, 47K down below 17K? There's often been that inverse relationship. So framing crypto as potentially helping the dollar, that signals a significant strategic shift, a political embrace perhaps.
And this isn't just talk, right? There are actual policy ideas floating around. Senator Lummis.
Right. Senator Lummis is still pushing her idea for a strategic Bitcoin reserve. The proposal is to start with the Bitcoin. The government already holds about 130,000 BTC seized over the years.
That's worth around $34 billion now.
Roughly, yeah. And the idea is to use that, potentially, as an asset to help offset the enormous $35 trillion national debt, using Bitcoin as a strategic reserve like gold.
And you know the market loves this kind of talk. The Trump coin, Trump apparently jumped double digits in 24 hours after his speech.
Predictable reaction, yeah.
But
High-level political validation tends to do that.
it's not just national politics either, is that even local races are seeing crypto become a talking point. New York City.
Yeah, in the NYC mayor's race, there's this group, Innovate NY, a pro-digital asset pack. They endorsed Andrew Cuomo. Why? Because he promised, if elected, to set up an innovation council focused specifically on blockchain, tokenization, and AI.
So from the White House down to City Hall, digital assets are firmly on the political agenda.
Okay, speaking of big players making moves, let's do our focus asset deep dive. You mentioned XRP showing signs of serious accumulation.
That's right. There was a huge move recently, 42 million XRP, worth almost $98.6 million at the time, transferred off the Gemini exchange into an unknown wallet.
Off-exchange usually means.
Usually means long-term holding, is generally interpreted as accumulation, not staging for a sale. Suggests institutional players or large holders are taking it offline, planning to hold.
Okay, so big money is accumulating while the price is kind of treading water near support levels. What other metrics back up this bullish interpretation? You mentioned spot taker CVD.
Yeah, the spot taker cumulative volume delta, or CVD. It's a way to track buying versus selling pressure in the spot market over time. And lately, it has shifted pretty definitively towards buyer dominance. More aggressive buying than selling at current prices.
So people are actively buying into the current price range. What about derivatives, funding rates? Funding rates spiked massively, up 247.57%. That's a huge jump.
And what does that mean practically?
High positive funding rates mean traders opening leveraged long positions are paying a big premium to those holding shorts. It shows overwhelming optimism in the derivatives. Market traders are betting heavily on an imminent price increase.
Okay, strong spot buying, massive optimism and leverage. What about the NVT ratio? That dropped.
Yeah, the NVT, network value to transactions ratio, dropped about 30.7%. This metric compares the market cap to the actual transaction volume happening on the XRP ledger.
And a drop means?
A drop generally suggests the network is seeing robust use, lots of transactions, relative to its current market price. It's often interpreted as a sign of potential undervaluation. The utility or activity is high, but the price hasn't fully reflected that yet.
Right, so you've got whale accumulation off exchanges, strong spot buying pressure, extreme leveraged optimism, and a valuation metric suggesting it might be undervalued based on network use. That all sounds pretty constructive.
It definitely paints a bullish picture from an on-chain and derivatives perspective. The price is consolidating, hovering near that $2.20, $2.30 support zone.
And the key level to watch is?
The critical resistance is around $2.65. If XRP can break decisively above that, the technical setup suggests the next major target could be around $3.12.
Definitely one to keep an eye on then. Wow, okay, that was a whirlwind tour. We covered ARK's nuanced forecast, the whale versus small buyer split, miners becoming AI infrastructure providers, that massive $2 trillion tokenization prediction, political endorsements.
It really covers the spectrum, and I think the key takeaways boil down to this. The market's stabilizing, yes, around 100K, but it's also getting much more sophisticated.
Right.
We see clear specialization in Bitcoin as gold, stable coins of payments.
And those powerful institutional pivots, miners powering AI for Microsoft and Amazon. That's huge.
It is. And that brings us to the really interesting final thought, something for you, the listener, to consider. Our sources today show the actual physical and financial infrastructure built for crypto is being absorbed, integrated into the core global economy.
Miner hardware powering AWS and Microsoft Azure, governments talking about using confiscated Bitcoin to back national debt.
Exactly. So the question is, if the underlying infrastructure of the crypto world is now essential for global AI development and even being considered for national reserves, Does that mean this asset class has finally moved beyond pure speculation, has become a foundational, maybe even non-optional utility for the decades ahead?
A provocative question indeed. Something to definitely chew on as these structural shifts continue to play out.
Thanks for joining us for this deep dive.
We'll catch you on the next one.